I've often said that property investment's a game of finance with some houses thrown in the middle. But currently more and more investors and homeowners are having difficulty getting finance in this rising interest rate environment. So what should you do? What type of finance strategy should you have to prepare yourself for what's ahead? And how do you deal with the banks? Oh, by the way, do you know about private lending channels, what they are, and how maybe you could take advantage of them? That's what I discuss in today's podcast with Danielle Gold. And what we discuss today isn't just for if you're looking to get finance for your next investment property or your next property purchase, but we're going to discuss some strategies for those who already have a mortgage to prepare for what's ahead. And then I have a chat with Greg Hankinson, Director of Metropole Constructions, about how much building costs have risen recently and what's ahead for construction costs. And obviously this has implications for our property markets. So welcome to today's show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
If you're interested in property, you can't steer clear of all the news about rising interest rates, can you? And as I said in the introduction, finance is an integral part of property investment. But over the years, I realised that most investors don't have a finance strategy. I guess most investors don't even have a real property investment strategy. To them, buying a property is a strategy. No, it's not. So what strategies should you employ in this interesting stage of the property cycle? That's what I'm going to ask Danielle Gold Award-winning finance broker and principal of Long Property. Hi, Dan.
G'day, Michael. How you going?
Good, thank you. Well, we're going to talk about finance today. And look, in contrast to last year, the Reserve Bank was telling us for quite some time it wouldn't raise interest rates till 2024, and then interest rates started rising in May this year, and the Reserve Bank delivered a shock and awe campaign of some massive interest rate increases, and we're likely to see a few more rate rises before this cycle's out. Now, look, obviously it's all about trying to bring inflation down to more reasonable levels, but of course this is also going to have an impact on borrowers, those on variable interest rates currently, and those coming off fixed interest rates. A lot took fixed interest rate loans over the last couple of years, and they're going to come out of those facilities next year, and they're going to have higher monthly mortgage charges. So clearly this is hampering some investors' borrowing capacity, and the banks seem to be more cautious than ever. So let's cut to the chase, Dan. How do you deal with the banks in this rising interest rate environment?
Yeah, thanks, Michael. Well, it's definitely been a very difficult time for a lot of finance professionals and, borrowers that are going through the loan process. We estimate that from May until now, we're doing this recording, mid-October, that people's borrowing capacities on average have declined by about 15 or 20%. And people's borrowing capacities are really a moving target at the moment. Each time the Reserve Bank raises interest rates, people's borrowing capacities may be impacted if they're looking to borrow at the upper limit of what's available. So there are so many things that borrowers can do to ensure that they're still borrowing safely and ultimately to get the results that they're intending to. And then you touched on it, Michael, but just with all of those fixed rate and in some cases interest-only expiries as well, there are a lot of things that borrowers can do to really just reduce the risk of any major shocks when those expiries take place. I think it all comes down to being prepared, Michael. So don't get in touch with your banker or your broker a month before these expiries take place. You've got to be proactive. You've got to be speaking with your bankers and brokers regularly and really have plans in place to navigate this changing landscape.
Now, you're being very politically correct, Dan, and saying your banker or your broker, but we both know that we don't recommend people go directly to the bank. And it's not because we have a vested interest, but the bank with the blue logo is not going to tell you that the bank with the yellow logo has got a special deal for people in your particular industry. Or currently, banks are actually very keen to get new business. They're offering special rates, special deals, honeymoon rates, and even incentives to swap, and the local bank won't tell you that, will it then?
Yeah, that's exactly right, Michael. And not only that, but I guess if you are dealing with a bank directly, that the people that you're dealing with there, primarily their job is to service your immediate loan requests. They're possibly less likely to be striving towards developing a longer term relationship with you as a client, and therefore less likely to be proactive in enhancing the client and advisor relationship along your journey. So you'll find that a lot of savvy brokers, for example, just have very simple policies or systems and processes, I should say, in place, maybe to check in with their clients on a biannual basis, offer a health check or an annual review every 12 months on an anniversary of a loan or on the expiries. And they're the types of things that can just safeguard borrowers from, all of a sudden waking up realizing that there's a repayment shock when repayments have gone up by a significant amount.
See, if I hear correctly, one of the things you're saying is don't leave it to the last minute, be prepared. And that's part of having a strategy in place. The other comment you made a while ago was if you're wanting to borrow to your maximum capacity. I know part of the finance strategy we recommend at Metropole and you do at Long Property is actually also using some of your finance capacity to have a buffer to buy you time, not just buy you properties. And that makes it a much easier way of riding the ups and downs of the interest rate and the property cycle.
I definitely agree with that. And sometimes it can be a little bit counterintuitive for maybe less sophisticated borrowers who are newer to these types of concepts. Initially, some might assume that a higher loan amount could be placing them in greater financial risk. But to your point, I found, and even just in my own personal experience, generally speaking, when you've got more money in the bank, you do feel a little bit more comfortable. You buy yourself time, Michael, like you said. And in addition to that, in most cases, you won't be paying anything extra, right? Because the amount that you're actually paying in terms of interest is calculated on your loan amount net of offset. And therefore, if you're getting a higher loan, generally that would mean that you're keeping more of your own money in your offset account, and the actual net balance of your facility limit is probably the same, in which case you would be paying the same amount of interest to the bank in both scenarios.
Now, of course, one of the things we recommend is people get a pre-approval so that when you go out into the market, you know where you should be looking, what your budget is. How useful are they today in this changing interest rate environment?
Yeah. So if we're going to focus on one thing today, Michael, this is probably the key part, because pre-approvals, even in normal times, they differ between the various lenders. And therefore, people are borrowing significant amounts of money to buy real estate. It's a process that needs to be handled very carefully. But in today's environment, with things changing so frequently, in particular interest rates, which impact people's borrowing capacities, even more so than ever. So if you don't mind, Michael, maybe we spend a few minutes on this topic in it. Let's
Sure,
go.
happy to.
Okay, cool. So I guess one of the key things that people need to understand is, firstly, that a pre-approval that you might obtain does not mean that you've got a particular loan amount locked in for any period of time. Generally speaking, a bank will assess the inputs into your loan application, and then they'll give you an indicative approval that's really valid at that single moment in time. But if it takes you 3 or 4 months to buy your property, and by then interest rates have gone up and your income may have changed, then that original loan amount is basically invalid. The bank will simply recalculate what loan is available to you at the point of formalizing your loan application, which is when you've bought the property. Okay.
And it also depends upon the type of property you buy, because there are certain types of property or postcodes or property sizes or locations the banks are not as keen to lend as much on.
Absolutely. Different postcodes, different property types, all of the above. So thankfully, there are a couple of banks in the current environment whom are being good enough to notionally, let's call it, hold the pre-approval amounts for a period of 90 days, okay? And there are some banks that will do this, other banks that won't do this. And even the ones that do, it's still, marked with several asterisks. And in particular,
Hey, I learned a new word. I didn't know what the plural of
word?
asterisk is. Thank you.
But so there are multiple things, and the two big ones are often that so long as your loan amount remains the same or lower, and your loan to value ratio that you end up transacting at also remains the same or lower, then the amount that you got pre-approved for, so long as the property type and everything else kind of checks the boxes, can be maintained. And that is a very, very, very useful policy, particularly for first home buyers, particularly maybe for second home buyers who are upgrading into the family home. They're the cohorts that typically push a little bit higher in terms of what borrowing capacities are available to them. And they just can't afford for, their capacities to be lower when they're, 4/5 the way into a property transaction. So we're being very careful with which banks we're lending with. And also, it goes without saying that pre-approvals, particularly those that are a little bit more complex, need to be manually fully assessed by the banks and not just algorithmically assessed, because that can also just be fraught with danger.
In other words, it may not fully understand the circumstances and not lend you what you deserve to get. What are the bank's pricing policies that we need to be aware of? For example, are the published rates negotiable?
Yeah, published rates are absolutely negotiable, particularly with the major banks. In fact, most borrowers that have secured finance with the mainstream funders will have realised that, particularly on the home loan packages, which are most common, the loan products that tend to come with an offset account, that the published rate is just a standard variable rate, which is quite expensive, and your end rate that you get as a borrower is dictated by the discount from that. Those discounts are definitely negotiated. There's this process that bankers and brokers use to secure the best discounts, and often there's a bit of back and forth. With a lot of the non-bank lenders, or smaller banks, I should say, they typically just publish their rates on a rate card, which gets updated from time to time. And it's a bit hit and miss with those banks, Michael. Sometimes you will get a bit of a discount, other times you won't. Can't hurt to ask, but often it's just based on timing and what level of appetite that lender has at any given moment.
Now, banks advertise a comparison rate. What does that mean?
Comparison rates have never really been all that relevant for most of my clients, but really a comparison rate is just something that helps clients compare different loan products side by side beyond just their interest rate, but also taking into account the various fees and charges that a loan product contains. For example, an establishment fee, an annual fee, those types of things. But the only way that they can really do that on a like-for-like basis is they've got to choose a particular loan amount that they compare each loan product with. And those loan amounts tend to be very small, maybe like $150,000 or $250,000. And therefore, for anyone that's borrowing larger loan amounts, doesn't have to be an enormous loan, but even a $500,000 or $750,000 loan is multiples above what I just mentioned. And therefore, you'll find that the interest rate becomes a larger component of the overall cost.
Makes sense.
And therefore, that interest rate is probably more useful to borrowers than the comparison.
Well, I bet a lot of people come to you, Dan, and say, I want the best rate. And intuitively, you can understand why they say that. But really, it's not always rate related, is it? There's a lot of other factors you look at when you put a finance strategy together for our clients.
Absolutely. Often you'll hear people say that the rate's important, but there are so many things beyond that. And I think, Michael, for some of the reasons we touched on earlier, that is the case more so now than ever before. So I'm not saying that the rate's unimportant. It's absolutely critical. But for 9 out of 10 borrowers, even if they had to pay 5 or 10 basis points more for their interest rate, and in many cases they wouldn't even need to, but the benefits around knowing very accurately what loan amount they can secure, the benefits of maybe being able to secure more funds rather than less, and the ability to transact both confidently and efficiently are going to be worth far more than $100 here or there on an interest rate. And in particular, in the current market where finance is challenging with all these changes and higher levels of interest cost, a lot of your competition might be struggling. And therefore, if you've got certainty around what funds you're able to secure and you can move quickly, then that could be the difference between maybe negotiating a small discount on the acquisition price or not, or even just being considered by a potential vendor.
That's a really good point, because it puts you in this current buyer's market in a very strong position, doesn't it?
We've had clients secure significant discounts by acting decisively and putting in an unconditional finance offer with proposed settlement in 30 days. Okay. Now, if you're a vendor and you're comparing that to something that's all wishy-washy, heavily conditioned with settlement in 4 months, what are you going to choose? Most vendors will much prefer the certainty. And again, I've got to stress, buyers need to be so careful acting that decisively with any kind of proposed offer. But when you've got the right banks supporting you and you've got the right advisors behind you, those types of things are made possible. And yeah, we've seen some really terrific wins there.
Now, it's often said that existing clients are paying a loyalty tax to stay with their banks, and new borrowers are getting a better deal. How do you work around this?
It goes back to what we were talking about earlier in terms of just being proactive and being prepared. So long gone, Michael, are the days where, mum and dad gets a home loan, sits on it for 20 years, eventually pays it off. On average, I would be speaking to each one of our clients at least 3, sometimes 4 or 5 times per year. And a big part of that is just ensuring that their positions remain optimized, even if they're not transacting again. What we've found, Michael, over the last short while, with all of these increases that the market has experienced on higher fixed rates, the banks are still, competitive beasts, and they've been continually discounting their variable rates more and more aggressively over the last 12 months. And what that means is any client really that's on a variable rate that hasn't been looked at for the last, say, 6 to 12 months is probably paying slightly above the odds. And sometimes it's as simple as just going back to the incumbent lender and saying, hey guys, we noticed that your the variable rates that you're offering new to bank clients are much cheaper than what we're currently on. Can you sharpen the pencil? Can't hurt to ask. Oftentimes they'll simply just reduce the rate for the borrower, and if they don't, you can always look at refinancing and going elsewhere for a better deal. So some really easy ways to ensure that you've just got ultimately more money in your back pocket and less money in the banks.
And that's what your good finance strategist should be doing, keeping an eye on those things for you. So putting all that together, how do you get the best deal in today's environment?
Well, there are so many things, but I mean, it goes without saying that as a starting point, working with a good broker should deliver you more options. And 9 times out of 10, once you've got more options, you're going to get a better deal, whether that's, a cheaper interest rate, more borrowing capacity, more certainty, better service, you name it, right? If you don't have a good broker that's proactive with your relationship, maybe ask a friend, see if they've got a good recommendation for you anywhere where they've had good experiences in the past. Look for brokers that have themselves had a lot of experience personally and professionally within their businesses, and so on and so forth.
I'm going to do a shameless plug at this point too, because we work with you and you work with our clients, and we've been doing that for quite a number of years. So if you're really stuck and you're wanting to speak to somebody, I'm also going to leave a link in the show notes to Long Property. You've been very politically correct, Dan, and not plugging your own services, but clearly I wouldn't have you on this podcast if I didn't think you could provide that level of service. So let's get back to how you get the best deal.
No, thank you, Michael. I do appreciate it. But at the end of the day, you need someone in your corner. I think the other key thing here is that not only by having more options are you more likely to get a better deal, but I think as well as that, the more borrowing capacity you have, the more options you're going to have in terms of growing your portfolio or also qualifying for these better deals. And there are so many different tactics and strategies that people can use to enhance their borrowing capacity. And that's a whole another body of conversation that we regularly have with our clients when we're doing these reviews and regular catch-ups.
Dan, tell me a bit about the private bank channel. What are they and how do they differ from the typical retail banks that most of us know about?
Yeah. A lot of people, when they hear private bank, they get a little bit confused with private lenders and private funders. That's not what I think you and I, Michael, are talking about here. Private lenders and funders are different lending institutions. What we're talking about here are, certain channels of the mainstream funders that we're all familiar with, whom have dedicated little arms of their businesses that are really set up to maybe manage some more complex and larger clients. So, we've been dealing with these private bank channels for really since day one, since we started our business. And they can be very useful. They're not for everybody. There is a whole bunch of criteria that needs to be met in order to qualify for these arms. But where we've found the biggest wins are definitely for these more complex scenarios that might require an exception to the standard credit policy. Say, for example, you've got a complex self-employed scenario whereby, particular income streams, when viewed by standard credit policies, might hinder what a borrower is capable of achieving. The private bank might look at something in a slightly more commercial way, and that might help the borrower kind of either unlock some equity or buy their next property or whatever it might be. Yeah, they're probably the big ones. Like I said, there is criteria, so just be mindful of that. And also we have found that private bank, that there are lots of layers in place, and therefore it can be a slightly slower process than just dealing with the more commoditized mainstream retail arms of the banks. But again, just comes down to having options, and that's our job, just kind of placing the clients with the best options that suit them.
I guess most people don't realise that there are a number of doors where you can get into the bank. There's the front door, the retail door that most people get into. There's the private door around the corner for more sophisticated investors. And I guess Rupert Murdoch doesn't go in the same door as I do in the bank either. So there's another level as well. But that's why it's good having somebody on your side who understands the banking system. And I know it's been a challenging time for you and all finance brokers over the last couple of years with the continual changes, keeping up to date with this. But that's, I guess, where you're leveling the playing field. How can the ordinary investor understand all these things?
Totally. I mean, it's hard enough for us, and to keep on top of all these changes, which are literally moving weekly, if not daily. But it just goes back to having more options. And another thing I'd say there, Michael, is that, as brokers, we just see this constant variety of new scenarios on a daily basis. There tends to be a solution for everybody. Those solutions might not necessarily mean the cheapest interest rate that you can look up on the internet, but even for the really tricky ones, there's generally finance available, albeit sometimes at a cost. The more complex, the less lenders that there might be available, and that they might be able to charge you a premium, and rightly so if you don't conform to every one of the standard boxes,
So I guess the bottom line is the banks are open for business. You've got to get the best deal that suits you, and the best deal isn't always related to the interest rate. So get a good team on your side and have a finance strategy. Part of the strategic plan the team at Metropole put together is a finance strategy. That's the first bit, because that's determined by the banks, and only then can we decide where you're able to buy. Maybe the finance strategy means you're not going to be able to buy in the big markets of Sydney or Melbourne and you have to go elsewhere. But the strategy isn't just getting money, but actually able to buy time as well. Dan, thank you very much for your time. I'm going to leave a link in the show notes about Long Property, your company, where people can find out a bit more about you. Look forward to having you on again and talking about finance again in the near future.
Michael, I appreciate your time. And just one message to leave with borrowers.
Yes, please.
Particularly for anyone that is looking to purchase soon and going through the pre-approval process, please just speak with your broker or your banker before buying anything, just to triple check that your finance is still on foot, that you're going to be able to still secure the amount of lending that you had planned, and that'll just mitigate all risks and ensure that there are no nasty surprises once you've committed.
A very good message to finish off with. Thanks, Dan.
Good on you, Michael. Have a great day. Thank you.
Well, I hope you learned something new about finance in my chat with Dan Gold, and I'm going to, in a moment, share my mindset message with you. But beforehand, I'm going to be talking with my business partner in Metropole Constructions, Greg Hankinson, about rising building costs and what's actually happening on the ground in the construction industry and what that may mean for the cost of new dwellings moving forward. Because obviously, if building costs cost more, new buildings are going to cost more, and that's going to pull up the cost of established properties as well. That's one of the factors that's going to underpin our property markets and stop the nasty crash that some people are suggesting is going to happen. I think it's also going to mean that a lot of the new apartment complexes and even some of the new houses that are on the drawing board are not going to actually start being built at the moment because those projects are not financially viable. So the lack of new supply is another factor that's going to underpin our property markets. And yes, they are still falling a bit, and they will continue for a little bit longer, but maybe not as much as some of the property pessimists are suggesting, because rising immigration, all these people coming, the lack of supply of properties and rising rents, and the fact that our economy, even though it's slowing down a bit because the Reserve Bank wants it to, is still doing okay, it's actually doing quite nicely, is all going to mean that there's no mortgage stress and people aren't giving away their homes and property values aren't slumping. But we are living in uncertain times. We are living in difficult, I guess it's not just economic challenges, but political challenges, social challenges, legal war challenges, whatever. But as a property investor, it's going to be your responsibility to secure your financial future, your financial prosperity, because I guess I'm realising, I've known for a while, that the government's not going to be able to do it for you. I guess you've probably picked that as well. And that's why over 2 million Australians are investing in property to try and secure their financial future. But in these more challenging times, these interesting times, a lot of people are just sitting by the sidelines playing not to lose, shrinking away from the opportunities that are there. But there are opportunities for those with a long-term focus. There are people out there playing to win, recognising that the times we're living in do actually offer tremendous opportunities, and they're rising to the occasion, using time-tested, proven strategies and frameworks to minimise the risks and maximise their upside. And that's what we're doing with our clients at Metropole. Why not go to metropole.com.au and have an obligation-free complimentary clarity consultation with one of our property strategists to see if you can similarly do this, secure your financial future. Go to metropole.com.au. I'll leave a link in the show notes. And by the way, since we don't sell any properties, we can give you independent, holistic advice. My team and I are keen to share with you the frameworks that I've fine-tuned over 5 decades and the strategies we've been helping thousands of clients with for over 20 years now. I don't want you to regret not meeting with us and having missed out on this window of opportunity. So go to metropole.com.au and organise a time for a chat. What's happening to construction costs and what's ahead? Now, this is a common question that we're being asked by clients of Metropole, particularly people who are wanting to get involved in property development. To help you understand what's really happening out there, I'm joined by Greg Hankinson, Director of Metropole Constructions, and an almost 30-year veteran of the construction industry. Hi, Greg.
Hi, Michael.
You don't really look that old, but I know you've been a builder for a long, long time. Now, Greg, Cordell's Construction Cost Index, which is the industry standard, showed that in the third quarter of 2022, residential construction costs increased at a record rate. Interestingly, in New South Wales, just in the last quarter, construction cost increased 4%. In Victoria, they increased in a quarter, 5.6%, Queensland's 5.8%. That's a huge annual increase in construction costs, Greg.
It's extraordinary, isn't it, Michael? And it's unprecedented. We haven't seen these kind of increases in construction costs for a long, long time. And in fact, the ABS last 12 months till September 21 had a 12.6% increase in construction costs.
So what are the items that are costing more, Greg?
There's a couple of things at play that are causing construction cost increases. One is global supply. So on the back of COVID and travel restrictions, the global supply of building materials reduced. So demand was at an all-time high. So suppliers started charging a premium.
And it's interesting. You'd think with all the trees when you drive around Australia, we'd have our own wood. We don't get most of our construction wood from Australia, do we?
Well, we get a lot of it from Australia, but a surprising amount is imported. 100% right.
Yeah. What about the availability of trades and labour?
A similar issue with immigration is down. Now, not a whole lot of immigration is affected in the building industry, but skilled labour is at all-time lows. In fact, they're at lows since 2013. We just haven't seen these kind of skilled shortages, and it's around plumbing and electrical and carpentry and bricklayers in particular are one of the biggest hit trades.
Well, the construction industry is also facing other challenges: rising fuel costs, rising freight, rising electricity costs, shortage of labour, as we've said, expensive overheads, insurance. And I guess that's pulling down a lot of people who are good builders who just couldn't cope. And so there seems to be a lot of good builders falling by the wayside. What advice would you have for somebody who's actually looking to engage a builder to work on their project?
You're 100% right. And the upshot of those challenges means construction duration is much longer than it used to be. So it's taking a lot longer to build properties. And the result of that is construction costs are going up even further because builders are factoring in that extended building time into their costs. So it's going to continue to cost more and more because the buffer needs to be greater.
So one of the points I'd be suggesting is be careful the builder that you choose and make sure it's somebody that's financially sound, because even some of the big builders are having some challenges at the moment. Tell us a bit about what Metropole Constructions specialises in and why, if you're looking at doing something in Melbourne, you should consider using our services.
We specialise in boutique townhouse developments and luxury home builds. So we're in a very small market and we consider ourselves to be experts in that market. Primarily, it's for the investment market. So we focus on highest returns for the minimum expense. So what's the best bang for our bucks, basically?
And I guess that's because we're not just a construction company, but part of a bigger company that understands about how to create wealth through property. You're a successful property investor yourself. So you're actually not just thinking as a builder.
In fact, we don't think like a builder at all. Builders think about maximising the cost of construction because they work generally on a margin on cost. Whereas what we want to do is look at the most value that we can get for our clients for the minimum expense.
So what if somebody says to you, Greg, look, maybe I should just put off my project for 6 months, 12 months. Is it going to be cheaper next year?
The demand for new homes in Australia particularly is not going to decrease in the next 12 months. In fact, the ABS and the HIA are all predicting an increase in the need for detached housing. So there's no reason to believe that construction costs are going to reduce. They may slow down, the growth may slow down a little bit over the next 12 months, but they're certainly not going to decrease. So to answer your question, the best time to build is now.
I'd agree with that because this has happened in the past where there have been increased costs. You can't see tradespeople charging less. They may not be able to put their rates up as high and there may be more availability. There's not going to be a surplus of materials coming up in the next little while. So choose your right builder, get your budget right. I'd also suggest you actually allow a buffer because there's always extra costs. And if you're uncertain about what you should do, why not just have a chat with Greg Hankinson from Metropole Constructions? I'll be leaving a link to his details in the show notes.
Thanks, Michael.
Thanks, Greg.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's mindset message, I'm going to talk about the miracle of personal development. Now, that's a strong word, miracle, but that was the title given to an article by the late Jim Rohn. Now, by now, if you're a regular listener, you'd know that I often quote Jim Rohn in these mindset messages because he was so influential on my personal development. Jim Rohn passed away a number of years ago, but his messages are timeless. And I think this is one of his most important messages. So let's get on with it. Jim Rohn wrote, one day his mentor, Mr. Shove, said, Jim, if you want to become wealthy and happy, learn this lesson well. Learn to work harder on yourself than you do on your job. And Jim Rohn said, since that time I've been working on my own personal development, and I must admit this has been the most challenging assignment of all because this business of personal development lasts a lifetime. You see, what you become is far more important than what you get. And when I heard that lesson from Jim Rohn, it started me on the trail of personal development. So instead of asking about your work, your job, what am I getting? Instead, you should be asking yourself, what am I becoming? Getting and becoming are like Siamese twins. What you become directly influences what you get. Jim Rohn said, think of it this way. Most of what you've done today, you've attracted by becoming the person you are today. Now, I've also found that your income really exceeds your personal development. You know, sometimes income takes a lucky jump, but unless you learn to handle the responsibilities that come with it, it'll usually shrink back to the amount you can handle. And boy, have I seen that in the very many property investors I've dealt with and the people that I've mentored. In other words, if somebody suddenly hands you $1 million, you better hurry up and become a millionaire. I believe that if you took all the money in the world and divided it equally, you'd soon find that it'd be back in the same pockets, the same proportion as it was before. Jim Rohn explained it, that it's hard to keep that which you've not obtained through personal development. So he suggested the great axiom of life is to have more than you've got to become more than you are. So this is where you should focus most of your attention. Otherwise, you might have to contend with the axiom of not changing, which is, unless you change how you are, you're always going to have what you've got. Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?